The number I heard was 26,000. That's the amount of deductions, the minimum amount of deductions you have to have before you'd even consider itemizing. Is that right?
Yep, correct.
Okay.
Yeah.
This is Las Vegas Real Estate Now with local real estate expert Harvey Blankfeld.
With me now in studio, we have some new guests here. We have Austin Ward. We have Zachary Tompkins. They're here from Tompkins and Peters CPAs. First, let's talk about your primary residence. Zach, you made a note here about a Section 121 exclusion. What is that? What is Section 121 exclusion?
Yeah, so the Section 121 exclusion is just your primary residence exclusion. So if you've lived in your primary residence for 2 out of the last 5 years, you can go ahead and deduct $250,000 up to $500,000
Right.
if you're married filing joint from your excluded as capital gains. So you don't have to pay capital gains on that.
And that's on the profit of the home, not the actual sale price.
Right.
Okay.
Right. Yep. So that would be just the sales price minus what you originally paid for the property, and then what that difference is, you'd be paying.
Gotcha. Yeah, and if you had expenses for capital improvements to the property, can those be deducted as well throughout the process? Or
Yep.
Okay.
Yep. That adds to the basis. Any closing costs, that type of stuff, we can also capitalize that and add that to the base as well.
Okay, so then the other thing you have is when you own the home, you have deductions that you can take off your taxes year after year, right? And
Yep.
those are Schedule A deductions. Austin, you want to talk about those a little bit?
Oh, yeah, absolutely. So the basic ones we got is your mortgage interest, pretty much the first, you being in real estate, the first few, 5-10 years, you're paying pretty much interest on your loan at this point.
Indeed.
Property tax, which so far in Nevada, it's pretty good. It's pretty low, which
Yep.
I'm starting to see that a lot more.
Yes.
And then if you refinance, you're able to take the points. So the major thing with that is everyone kind of thinks that you can just... you pay this, you're getting that deduction. It really depends on if you actually itemize or if the standard deduction.
Right.
Which I think the current rate's about, for a married filing couple, it's about $26,000, just under that.
Okay.
So you have to have expenses above that for like charitable contributions, your mortgage interest, your property tax, anything like that.
Okay.
Home insurance does not count.
The number I heard was 26,000. That's the amount of deductions, the minimum amount of deductions you have to have before you'd even consider itemizing. Is that right?
Yep, correct.
Okay.
Yeah.
Okay.
And with the Tax Cuts and Jobs Act, they made it so you can only take $10,000 in taxes.
Right.
It's a very big thing. We deal with a lot of clients that are they're getting all these huge complexes that are basically like, hey, I'm paying like $35,000 a year in interest. Can I deduct this? I'm like, yes, please do.
You've been listening to Las Vegas Real Estate Now. If you ever have a question about real estate or any of the other topics we cover, just call me off air or text me at 702-203-1165. You can also check us out on the web at lvrealestateradio.com or on our handle on social media at LV Real Estate Radio.